How to protect your trades from volatility spikes. Markets can be unpredictable, and sudden price swings, also called volatility spikes, can catch traders off guard. Protecting your trades from these big moves is key to managing risk and avoiding large losses. One of the best ways to do this is by using hedging strategies. Many traders use options, which are contracts that let you buy or sell an asset at a fixed price. For example, a put option allows you to sell at a set price, even if the market drops. This acts like insurance for your trades. Another popular tool is the VIX index, also known as Wall Street's fear gauge. When markets become uncertain, the VIX usually rises. Some traders buy VIX options or futures to profit when volatility spikes. Recently, traders have been using zero-day options, which expire the same day they are bought. These can bring quick profits, but are also very risky. If the market doesn't move as expected, they can lose all their value in hours. Institutional investors, like hedge funds, often hedge their portfolios by buying longer-term protection. Retail traders, on the other hand, tend to focus on short-term moves, which can be riskier. One mistake traders make is waiting too long to hedge. By the time volatility spikes, protection becomes more expensive. The best approach is to prepare in advance, using small hedges when markets are calm to protect against sudden surprises. If you want to trade smarter and manage risk better, make sure to follow our channel for more tips. Hit like, subscribe, and turn on notifications so you never miss an update. Happy trading!